Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals, in our 26th year in business. It's Thursday, January 8th at midday, and the title of this week's audio blog is Tic Toc. Well, it's my first audio blog of the year, and like my first article, So How Did 2015 Start?, the litany of dramatic, dire events to discuss is as intense as it is broad. To wit, it was all the way back on October 7th when I penned 2008 is back with one temporary exception. The exception being the ability of government-supported stock markets to temporarily mask the underlying horrific reality that the global economy is collapsing with, for all intents and purposes, no security net. Yes, that was a full 3 months ago, and a week before the October 15th Treasury yield flash crash, when the 10-year yield plunged from 218 to 187 in a single hour, yielding a blaring warning sign of what's to come. When that occurred, by the way, I espoused that nearly always such gaps are inevitably filled in the coming weeks. And lo and behold, just 2 days ago, the 10-year yield nearly did so, hitting 1.89% and sitting at 2.01% as I write, en route to Japan-like levels near zero as the entire world front-runs QE to infinity. That is, until hyperinflation inevitably arrives, rendering all bond yield discussions moot. And by the way, the WTI crude price back on October 7th was still $87 per barrel, and $81 per barrel a week later, when I wrote crashing oil prices portend unspeakable horrors, compared to $48 a barrel this morning, black gold's lowest price in 5 years. Moreover, the crash indicator that the US dollar index has morphed into, given the dollar's superior liquidity as global reserve currency, was just 85.5 at the time, compared to a 12-year high of 92.4 this morning, as the dollar explodes higher on fears of global economic collapse, a breakup of the European Monetary Union, and Japanese hyperinflation. Back in early October, the signs were already blaring of global collapse, from flat-out contraction in Japan and Europe, implosion of the historic Chinese credit, real estate, and construction bubble, plunging industrial commodity prices, and of course, serially crashing currencies, i.e., the single most PM bullish factor imaginable. Obviously, I wouldn't have titled such an article so strongly if things weren't that bad. However, they obviously were back in October, and that was before oil plunged from $87 to $48, before the CRB index went from 280 to 225, just 14% from its 2008 spike low, before the 10-year yield went from 2.5% to 2.0%, before the Baltic Dry Index fell from 1,500 to nearly an all-time low of 725. And oh yeah, before the world's largest currency, the euro, went from 1.29 to a 10-year low of 1.177 as I write. The Russian ruble had not yet crashed, or for that matter, the US junk bond market, while the Greek exit from the euro had not yet been pondered. The Bank of Japan had not yet doubled up on Abenomics. The Bank of China had not yet initiated a string of policy easing measures, and the ECB had not yet commenced QE. Heck, back on October 7th, the US was still publishing surging diffusion indices and plunging jobless claims, i.e., the island of lies economic reporting I have long railed against, with Wall Street unwaveringly expecting significant Federal Reserve rate increases as early as year-end. And yet, I still wrote 2008 is back, a week after my October 2nd audio blog, Countdown to the Yellen Reversal, the latter of which is the subject of today's audio blog. To that end, Peter Pan aficionados are well aware of Tic Toc, the crocodile perpetually staking Captain Hook, who fortunately for Hook has a loudly ticking alarm clock in his belly. No matter how long Neverland exists, Tic Toc will always follow Hook's every step. And similarly, as long as the Fed exists, the onus of inevitable QE to infinity will stalk it, getting louder with each passing day. I have long written how the world has been duped by a soon-to-be 2-year-old scheme, likely cooked up at an April 11, 2013 closed-door meeting between Obama and the top 2 big-to-fail bank CEOs to convince the world the U.S. economy is recovering and the Fed's massive balance sheet reversible. Starting with the massive precious metals raid of the following day, financial markets have since been rigged on a 24/7 basis. whilst U.S. economic data has been surgically doctored, albeit not enough to fool anyone with half a brain, and relentless, nonsensical recovery propaganda showered upon us by the evil troika of Washington, Wall Street, and the MSM, despite the weakest actual economic fundamentals of our lifetime. Not that these stratagems haven't been used incessantly since the global economy peaked at the turn of the century, of course. However, it was roughly 2 years ago when the power that be clearly realized that the ill-fated fiat Ponzi scheme was nearing its end, and thus, without massive manipulation of all aspects of the public's financial and economic perception, the whole cancer-invested pyramid could literally come down instantaneously. Moreover, as both QE3 and Abenomics had just commenced, with calls for the same in Europe, it became essential to make sure precious metals didn't break out, as certainly as soon as gold fever broke out, the end of their fiat hegemony would be upon us. Recently, I've read a lot of work from the great David Stockman, a former Washington insider with great insights from the enormous malinvestment fostered by fiat currency Ponzi schemes, or as he calls it, the great deformation of economic activity and financial market performance. Not once does he mention overt market manipulation, mind you, but that's not his area of expertise. Instead, he simply focuses on the unstable, unsustainable nature of overvalued financial markets, over-indebted nations, corporations, and individuals, and overbuilt economies. Particularly, as I highlighted in last week's direst prediction yet, so much overcapacity has been created in the manufacturing, mining, and high-cost energy production sectors, to name a few, that it could take decades to unwind, just as it did in the oil markets of the mid-80s to mid-90s. Only this time, geopolitical and other extraneous factors have nothing to do with it, as today's deformations are solely the result of unfettered printing presses and the post-Glass-Steagall weapons of financial destruction created by an essentially unregulated Wall Street. In other words, until hyperinflation inevitably arrives, the death by deflation I wrote of earlier this week will swamp any and all efforts by the Fed, ECB, BOJ, PCB or PBC, and other central banks to avert it. Price deflation may in fact serve as the tax cut propagandized by Wall Street and Washington of the impacts of plunging oil prices. However, it will be dramatically offset, as it was in 2008, by individual corporate and sovereign bankruptcies. And of course, the more debt endangered by default, the more currencies will weaken in anticipation of additional QE. Which is why physical gold and silver were the best assets in the 1930s depression, the 2008 to 9 financial crisis, and all other economic panics of the past 5,000 years. Only this time, more fiat currency has been printed than at any time in history, whilst in silver's case particularly, the amount of above-ground precious metal supply has never been lower as a percentage of said currency. And thus, the power that be's need to suppress gold enthusiasm is unparalleled, let alone with global demand at an all-time high for both metals and global supply on the verge of collapsing. Until 2 months ago, the most blatant, egregious precious metal raids I had witnessed, amongst hundreds, were: number 1, the aforementioned April 2013 PM attacks, when gold plunged $250 in the 2 days following said closed-door meeting between Obama and Wall Street's finest, accentuated by Goldman Sachs's conveniently publishing an aggressive short sell recommendation on gold just hours before. 2, the May 2011 Sunday night paper silver massacre, when a supposed capture of Osama bin Laden, timed conveniently as silver was about to breach $50 an ounce, was blamed for a 15-minute $6 per ounce plunge amidst ultra-thin market conditions on a Sunday night when the Chinese market was closed for a holiday. Number 3, Operation PM Annihilation 1 on September 6, 2011, also conveniently on the day gold hit its all-time high of $19.20 per ounce, on Labor Day night when the entire U.S. financial community was on vacation, when gold was attacked by $60 per ounce immediately after the most PM bullish announcement imaginable, i.e., the Swiss National Bank devaluing the franc by 7%, in pegging it to the euro and destroying the last vestige of gold monetary backing. Number 4, Operation PM Annihilation 2 on December 8, 2011, when after much of the PM losses of Operation PM Annihilation 1 had been largely recouped, and gold on the verge of retaking $17.50 an ounce following a surprise rate cut by the ECB, gold was smashed by $60 per ounce, right at the COMEX open, of course, en route to closing the year another $150 per ounce lower. And how was this smash justified? Well, by the cartel leaking reports that the Fed, Bank of England, and Bank of International Settlements had, quote, intervened to suppress prices without discussing either how much or the reason for such blatant manipulation. Subsequently, those headlines were quietly rescinded from the wire services with no explanation given or validation whether they were true or not. And of course, neither the Fed, Bank of England, or Bank of International Settlements has since reported a decline in their gold reserves. Number 5, better known as the leap day violation of February 29, 2012, was perpetrated when, with gold back up to $1,790 per ounce, Bernanke was giving dovish congressional testimony in the semi-annual Humphrey Hawkins hearings. Suddenly, for no apparent reason, at the typical key attack time of 10 a.m. Eastern Standard Time, gold plummeted by $70 per ounce in 1 hour, ending the day $100 per ounce lower for no reason other than to deflect attention from the Fed's maniacal money printing intentions, which in that case were validated by the announcement of QE3 6 months later. And last but not least, number 6, when during the initial stages of the 2008 financial crisis, paper PM prices were viciously attacked to prevent their recognition as safe havens. Gold was driven down more than 30% and silver nearly 60% in a matter of weeks, falling faster than even the equity markets despite record buying of physical metal. By the time the crisis peaked in early 2009, gold had recouped all its paper losses, and as for silver, its paper price may have taken longer to recover, but physical premiums reached 100% of the paper prices, as every mint in the world sold out of product. Why did I give you all that history now? For one, to demonstrate that when it comes to gold manipulation, I know what I am talking about, having spent nearly 13 years dedicated to studying it. Secondly, for listeners who lived through one or more of those horrifying capital-destroying raids, especially if you owned mining shares, to remind you just how evil and egregious the cartel, or as I call it, the New York Gold Pool, has been for such a long time. And finally, to give added emphasis to my claim that the pre-Swiss referendum attacks of November 2014 and the pre-FOMC raids of mid-December 2014 trump them all in blatancy and desperation. Not to mention what we have witnessed in just the past 24 hours surrounding yesterday's afternoon's publication of these so-called minutes of the aforementioned December 17th FOMC meeting. Back in early November, just as 81% of Catalonians were voting to secede from Spain, initial polls of the upcoming November 30th Save Our Swiss Gold referendum suggested it would pass. It was in my opinion then, and is now more than ever, that a yes vote may well have been the cartel's demise, as along with the massive Swiss buying that would underlie the market for years to come, undoubtedly other nations would demand similar attention to gold and silver's monetary value. Subsequently, an utterly epic series of nonsensical price smashes and unconscionable anti-gold propaganda, led by the Swiss National Bank's chairman, Thomas Jordan, amidst the most PM bullish fundamental environment imaginable, was unleashed on the gold and silver markets, right through the ultra-thin half-day of post-Thanksgiving trading on Friday, November 28th, when for no reason whatsoever, gold was maimed, again, right at the COMEX open, by $25 per ounce, and silver by a ridiculous 70 cents an ounce, or 4.5%. Frankly, it almost makes my non-conspiratorial mind wonder as to why Sunday, November 30th was chosen for the election date. Anyhow, when the vote occurred that weekend, resoundingly rejecting the referendum, U.S. price gold and silver were sitting at multi-year lows, and more importantly, Swiss franc price gold at $11.27 per ounce, mere percentage points above its 10-year low. The very next day, prices surged anew, and coupled with the franc's subsequent plunge, thanks to being tethered to the collapsing euro, Swiss franc price gold just 5 weeks later sits at $12.36 an ounce, 10% higher, whilst the Swiss franc has plunged 5%. Following that episode of unparalleled market rigging, we only had to wait a week before the key attack event that was the December 17th FOMC meeting. What, with all the hype of how the Fed would remove the considerable time language from its pathetic policy statement, subsequently, unfurling relentless propaganda regarding economic recovery, imminent rate increases, and the end of precious metal demand as we have known it. Thus, despite the oil price plunge becoming a major real-world issue at the time, as well as emerging Grexit fears, the serial collapse of countless currencies, and oh yeah, plunging treasury bond yields, the powers that be stepped up the November market rigging activities to a new level of lunacy. To wit, from the morning before the FOMC meeting, when markets were crashing and global collapse fears at a fever pitch, the PPT goosed the Dow Jones Propaganda Average, as noted in my 853 points of infamy article, by nearly 900 points in the ensuing 48 hours, which of course covered the period when the FOMC statement was released, which despite propaganda to the contrary, decidedly did not remove the considerable time language. Similarly, 10-year yields were goosed from 205 the morning before the statement to 223 after it was published, and when all was said and done, the Dow peaked a week later 1,100 points above the pre-FOMC low, and the 10-year yield at 2.30%, 25 basis points higher. As for gold, it was mauled heading into the meeting from $12.40 an ounce days before the meeting to its pre-Swiss referendum low of $1,170 an ounce a week later, and this amidst an accelerating flurry of PM bullish developments. Once that hullabaloo subsided, the third straight year of year-end PM raids commenced, again culminating with the ultra-thin New Year's Eve day raids. Despite several pieces of tremendously PM bullish data that day and plunging crude oil prices, yielding a nearly $30 gold price plunge from the prior day's highs and $1 per ounce for silver. Which brought us to this week, which started the year with gold and silver surging, albeit in prototypically capped manner, by $35 per ounce and 90 cents per ounce respectively on Monday and Tuesday, amidst a deflationary environment of utterly collapsing crude oil, commodities, currencies, equities, and bond yields. In other words, exactly what I was speaking of on October 7th when I wrote 2008 is back, with one temporary exception. However, as in mid-December, when a crucial FOMC meeting also happened to be scheduled right amidst a nearly identical market panic, the powers that be realized something had to be done immediately, as the last thing they wanted were for the FOMC minutes to be interpreted as backtracking en route to the inevitable Yellen reversal that Tic Toc the financial alligator represents. Thus, the exact same playbook was taken out Tuesday afternoon, i.e. 2 days ago. At the time, gold and silver were surging. Crude was crashing below $48 per barrel. The 10-year Treasury yield hit 1.89%. And following a 330-point decline on Monday, the Dow Jones Propaganda Average was down a similar amount Tuesday morning. The FOMC meetings were looming just 24 hours away, so magically the Dow started massively rallying, erasing 2/3 of its losses and nearly turning positive at one point. The 10-year yield moved up to 1.95%, giving the Fed the opportunity to goose it to the key psychological level of 2.0% in unison with the minutes publication. And gold, of course, was slowly walked down. Yesterday, with oil prices still around the 5-year lows of $48 per barrel, including just $35 a barrel for Canadian heavy oil, a plunging CRB index, all-out collapse of the euro, which has only accelerated this morning, a slew of bad economic data, and exploding Grexit fears, Dow futures miraculously rocketed higher, whilst PMs, of course, were attacked. An utterly comical ADP employment report was published to try and fool people into believing the economy was recovering, but that didn't help the powers that be's cause, as gold still hung around near its highs, oil still sat around $48 per barrel, and the 10-year yield still held around 1.95%. Finally, the minutes were released yesterday afternoon, which I mock the word minutes, as I don't believe for a second that what is reported is what was actually said. To wit, FOMC meetings publication has simply become another market manipulation tool and key attack event for precious metals, irrespective of what said minutes actually say. Generally speaking, nothing incremental ever emerges from the minutes, as anything truly material was revealed at the initial press conference a month earlier, and all else via countless speeches given thereafter by the various Fed governors. And lo and behold, yesterday's minutes did in fact reveal incremental information this time, which was violently PM bullish. And frankly, it was probably added in, as I said. Recall, the December 17th FOMC statement claimed the Fed as viewing the risk to their labor market forecast as balanced, with roughly an equal chance of improvement and decline. Similarly, the oil price plunge at the time was deemed transitory, and no mention whatsoever was given to the collapse of global economies, currencies, and commodities. I mean, when you're in the midst of goosing markets to enable strong year-end Wall Street bonuses, why would you even refer to reality, let alone have a negative take on it? Keeping this omission in mind, it was quite surprising to see yesterday's minutes claim many on FOMC saw a downside risk to U.S. from global weakness. Or better yet, demonstrating how whirlybird Janet is a flat-out liar. Recall that when asked at last month's press conference how many meetings it would take before an interest rate increase was likely, she answered, a couple. When asked for further specificity, she said two, meaning she expected to first raise rates on March 18th. And thus, the minute's declaration that Fed officials saw a rate rise unlikely before April clearly demonstrates that either she was lying or the notes were since doctored to account for subsequent developments. By day's end, the 10-year yield was still in the 1.97% range, oil was still $48 a barrel, and following relentless capping, gold declined by $7 an ounce. But don't worry, the Dow started the day by rocketing 100 points higher and closed at its highs up 213 points and 322 points above the prior afternoon's lows. And wouldn't you know it, right after the close, FOMC voter Charles Evans gave a speech claiming that, quote, raising rates would be a catastrophe. In other words, all aspects of this blatantly choreographed, confidence-saving manipulation operation were successful, particularly when the, quote, market reaction to Evans' comments were for stocks to explode higher, and PMs, which in the real world will benefit more than anything from increased money printing, were smashed down. This morning, oil is still $48 a barrel, following comments from OPEC delegates that there is, quote, no chance of reconsidering production levels. The euro is plunging further into the neverworld. The CRB hasn't budged from its multi-year lows, and this morning's jobless claims data suggested further labor market weakness heading into tomorrow's NFP report, which I can't wait to see. And heck, even Family Dollar, the dollar store, reported a massive, and I mean massive earnings miss due to, get this, higher discounting. I mean, how can you discount items that are all $1? Of course, all kidding aside, the reason for Family Dollar's profit plunge is the same reason why Samsung, the world's fastest growing smartphone seller, advised this morning that its 2014 earnings will actually be below the 2013 level, which is, of course, massive competition, as the death by deflation I wrote of earlier this week, based on David Stockman's work, takes hold, presaging the retail Armageddon I forecast in last week's 2015 predictions audio blog. However, despite the aforementioned massively equity bearish and PM bullish factors, Dow futures were up 175 points when I awoke, gold down $6 an ounce or so, and laughably, the 10-year yield at exactly 2.00%, as clearly, despite economic reality, the Fed was desperate to push rates above this key psychological level, so at least some semblance of credibility regarding the potential for future rate hikes, no matter how minuscule, could be maintained. Not to mention its desperation to prevent universal realization of what I call the most damning proof yet of QE failure, i.e. plunging rates despite a so-called recovery. Then again, it tried the same new Hail Mary tactic earlier this year at 2.6%. As noted in my May 7th article, 2.6% enough said, and later on at 2.2%, per my October 23rd article, 2.2% is the new 2.6%. Well, here we are at 2.01% this afternoon, a measly 12 basis points above Tuesday's lows, compared to the 25 basis point surge the Fed orchestrated ahead of its December 17th meeting. And gold is barely up $1. Oil is still $48 a barrel, and the Dow, drumroll please, is up 300 points, or 622 points above Tuesday morning's lows, when markets were in full-fledged panic because oil had fallen to, well, $48 a barrel. Throw in the fact that Greek default swaps are skyrocketing this morning, and the aforementioned horrible economic data, and you can see how incredible it is that, quote, markets are sitting where they are. I mean, think about it. When considering why precious metal prices have been stopped cold the past 2 days, amidst such violently PM bullish news across the board, here's what Asian CNBC outlet wrote of the initial response up to the Fed minutes and Charles Evans' comments. Asian equity markets raked in gains on Thursday as the fall in oil prices abated, while a positive finish on Wall Street overnight lifted trading sentiment. U.S. stocks jumped overnight, with the S&P rebounding from a 5-session dive as U.S. crude stopped a 4-day skid and Germany left the door open to discussing options with Greece's next government on its debt, which, by the way, has since been repudiated. The release of the Federal Reserve's December meeting minutes, which indicated the Fed wasn't ready to hike for at least the next couple of meetings, also helped sentiment. So free falling from 74 to 48 in a month's time, but temporarily rising to $49 before immediately falling back to 48 is considered an abatement of the decline? Quote, lifting trading sentiment? Better yet, sentiment was supposedly also helped by the FOMC minutes indicating a delay in rate hikes, despite the prior month's hype that said mythical hikes indicated recovery. And by the way, how on earth would gold not be soaring under such news? Let alone Reuters' brilliant commentary from this side of the pond under the completely counterintuitive headline that stocks and the dollar rise from Fed minutes. That stocks worldwide were bolstered by Federal Reserve confidence in the U.S. economy and hopes of aggressive new stimulus in Europe. Am I missing something here? What part of delaying rate hikes and introducing new, previously undisclosed global economic fears demonstrates confidence in the U.S. economy, particularly relative to a month ago? Oh well, I'm just doing my job of speaking the truth and calling out the lies, thus enabling readers and listeners alike to get their personal due diligence processes right. To that end, I wasn't kidding when I said 3 months ago that 2008 is back, and in the coming weeks and months, when the massive blowback from collapsing commodity prices, retail demand, and global currencies washes over the global economy like a tsunami, I can only pray you have taken steps to prepare. And if you do decide to protect your assets by purchasing or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Have a great weekend.